Well, firstly, we have had tactical funds who moved at the end of last year towards Europe, basically on the basis of positioning and valuations, and that's worked out very, very well.
Yes.
But looking at the year as a whole ahead of us, we still like the US. I mean, it feels now, what are we on, 7th of Feb or something? It feels like 7th of December, so much has happened already. And actually, but looking through those 12 months, we've got earnings set reasonably fair, we've got a good beat rate, north of 60%. And in Europe, we've got clients who are typically underweight the US and underweight the tech theme, all looking to correct that because it's been a pretty costly underallocation for a number of years now. But here's the rub. It's not going to be plain sailing for the year as a whole. And I think January shows that pretty clearly. Within the tech space and within the broader index, it's going to be a market that demands a pretty sort of granular, precise approach and quite a high degree of nimbleness and activity as well.
So you've got two things going on. You've got your longer-term strategical view and then you've got your shorter-term tactics as well. The latter takes you into market timing territory, which historically managers and the market are pretty average at, to say the least, as well. Do you feel confident tactically that there is a very clear trade between Europe and US at the moment, though?
Well, there has been.
Yeah.
And our tactical team have been fading
well
that a little bit, done well out of that.
Fading US.
But now looking ahead to the year as a whole, I think tech's an interesting one here. And what we saw in early Jan is pretty interesting and shows you how even within a theme, the focus can shift pretty rapidly. So we look to our strategies for pretty active management of the AI theme. And you look at the DeepSeek news, talking to our tech investors on the West Coast who manage these strategies, it's got a number of interesting implications. It obviously raised questions about Mag 7 capex, but that's just the top level. The really interesting thing is really that actually the models are now less profitable, potentially. Non-frontier models have a less well-protected moat, as they say. But actually this opens up new possibilities for software and apps and still requires, as we just heard, massive infrastructure and compute build-out. So the theme rotates a bit. And then at the same time, and this has got less attention, is the nature of the frontier models is really shifting, which is going to change the nature of the compute power that's needed. So all of this kind of tells us that there's opportunities in the tech space for really granular, really nimble returns from just navigating that theme.
That's great.
I mean, I've spent all week looking at it, and to me, Nvidia's come back into focus now because the hyperscalers are still spending, $250 billion for this year. So do you want to own the picks and shovels still because that spend is intact? Do you want to own the FANG Plus stocks because they think if they build it, they're going to see the growth down the track? Or do you want to move on a little bit to the other stocks that now haven't spent the money that can just extract DeepSeek values? So how do we think about those three pieces in the pie?
Well, I think it's going to shift through the year. And even in January, the focus has shifted from the model builders, and that was perceived to be where the moat was. Then we've seen huge flows in the US into exchange-traded products focused on software, which actually makes sense given the cost of production there is now so much lower. But also you've got to remember, and this is where the AI real expertise comes in, this is all about non-frontier models. This is all about making non-frontier models more efficient. And history tells us that value is typically accrued to those who push the frontier out as well. So you need as much focus there on these frontier models as you do on how things are shaping up within the frontier.